Good afternoon. I want to thank everybody for logging into our webinar today to talk about what you need to know about converting to a Roth IRA. It's a webinar we do a few times a year, usually to kind of let you know, especially this time of year is a time when people are considering trying to get a last-minute, possibly Roth conversion in and seeing the benefits that come along with that. So today's webinar will kind of go over some of the basics of traditional and Roth IRAs that you need to know. And then also go over some of the facts and kind of the reasons why or why not you would convert your traditional or tax-deferred IRAs into a Roth IRA account. Now, if you're listening to the seminar live today, please type any questions you have into the chat box on your screen. We'll make sure we get to those before the end of the presentation. If you're listening to the recorded version, you can simply call me. My information here is on this next slide. I'm Scott Maurer. I'm the Director of Business Development with Advanta IRA. I've been here with the company for a long time. But if you have any questions, if you're listening to a recording, you can either email me. There, my email address is on the screen. Also, my phone numbers are. Please give me a call direct. I'll be happy to talk with you about anything related to what we covered in the webinar today. If it's something that I didn't touch on, that you had a question in regards to self-directed IRAs, can certainly reach out to me for that as well. Again, if you have questions, type them into the chat box. I did have a question come in. Can I print out the slides? We will send the slides separately to you, so you'll have a copy afterwards. I'll make sure that we get those to you in the post-webinar email that we sent out. So we will get you a copy of the slides. So if you want to take notes, feel free to go ahead and do so. But we will send you, again, a copy of the slides that we have. Now, a quick disclaimer. I like to illustrate this every now and then when we're doing a webinar. But at Advanta IRA, we don't give any legal tax or investment advice. So we're talking about today is something that can have potentially great tax consequences to you, both good and bad, when doing a conversion to a Roth IRA. And the information that we provide is really of an educational nature. And if you're trying to make a decision, should I convert to a Roth IRA? Should I make an investment with a self-directed IRA? Those are things that we cannot answer for you. It's your accountants, your attorneys, your financial advisors who are able to give you that actual advice on whether you should or shouldn't do something. We just provide this information for educational purposes, really, to get you thinking, and hopefully if it's a topic that you're interested in, doing a little bit more research with those professionals, and we can certainly refer you to professionals if need be. Just a quick background on Advanta IRA. We're a self-directed IRA administrator. We've been around for a while now, and the only thing that we do at Advanta is to administer alternative assets in any type of IRA, traditionals, Roths, SEPs, simples, etc. We do the record keeping and administration for those assets. We currently have over $700 million in assets. We have over 5,200 active accounts. We have a commitment to customer service and education that I think is unparalleled in our industry. And then to that education, we do a lot of events. Obviously, you're participating if you're listening either live or on the recording. You're participating in one of the events that we like to do on a weekly basis. We'll either have a live seminar or a recorded webinar available to you on a number of different topics. We like to bring in guest speakers and really educate individuals not only about self-direction, and that's what we do in a lot of the webinars that we talk about, but all the areas that are ancillary to that. And today's webinar is one of those. When we're talking about converting to a Roth IRA, it doesn't necessarily have to be converting your self-directed IRA. It could be converting just your regular traditional brokerage IRA, whether or not that makes sense. So again, we like to provide this information. We have the Advanta On Demand, our YouTube page, where some of you, again, may be watching this on the recorded version. That's available with a lot of different topics, a lot of different guest speakers that we've had in the past. But again, today's webinar is focused on really converting to a Roth IRA, what you need to know about that process, so that you can make an educated decision if converting is the right thing for you. But I thought we'd start with just a little bit of the history of Roth IRAs and really where they came from, how they came into being. And they started, IRAs in general, started in 1974. And that's when traditional IRAs were created under Title II of the ERISA Act that allowed for individuals to start saving for their own retirement account, not related to whether or not they had an employer's plan that, or a qualified plan through their employer. Up until 1974, a lot of retirement plans in this country that were tax-advantaged retirement plans, individuals had them because they worked for an employer that was offering them that type of plan, usually in the form of a pension, that enabled them to save for their own retirement, have those tax advantages with those types of plans. But unfortunately, for a lot of other individuals, they weren't working for an employer who offered them a pension plan. Therefore, they could not make those same contributions. They didn't get those same tax benefits. So traditional IRAs helped address that and allowed for individuals to save for their own retirement and make contributions regardless of whether or not they were invested in their own particular company-sponsored plan. And it also allowed individuals who had monies in pension plans, once they left an employer, to be able to roll those over into an IRA as well. Now, at the time the IRA was created, it was only for individuals who could not, or it was only for individuals who weren't involved in a company-sponsored plan. So individuals who had pension plans through their employer were not eligible to contribute. They simply said this IRA is only for individuals who are not involved in a company-sponsored plan. Now, in 1981, the rules were changed a little bit. Not as many people were contributing as the government hoped. And generally the genesis of all retirement accounts, IRAs, pensions and whatnot, or the more money that you have saved as an individual for your own retirement, the less you are going to rely on government for services and other things you might need at that point when you get to retirement age. So the government wants individuals to fund IRAs. They want individuals to fund 401k plans. So in 1981, Congress sees that not as many people are funding IRAs as they were hoped when they passed this first law. So they do open up eligibility to everyone, regardless of whether or not you were in a pension plan or not. Everybody who worked and had earned income could contribute to a regular IRA account. Now, in 1986, the big tax changes that happened in this country. Part of that was to eliminate deductions for contributions to traditional IRAs based on whether or not an individual was covered in an employer's plan. And that is still in place today. Now, what happened in 1980, between 81 and 86, is simply that more people started contributing. These contributions, again, were largely being made by people who not only they were already covered under a pension plan, now they were eligible to contribute to a traditional IRA as well, so they were making even more contributions, and they were getting a tax write-off. They were getting that deduction for the contribution to a traditional IRA that we all are familiar with now. So in 1986, the tax law changed and said, okay, well, we're not going to allow for deductions for people putting money in a traditional IRA if they are covered by their employer. So it's going to have to go in as an after-tax basis. And so, again, changes in tax law end up changing a little bit of our behavior. Individuals stopped contributing. If I'm not going to get a deduction for my contribution to a traditional IRA, then I'm simply not going to make that contribution. Or I'm making this money with money that's basically after tax because I didn't get a deduction, but all my gains in that account are going to be tax deferred. I'm going to still pay tax on the gains down the line. So again, a dip in contributions ends up giving rise, and here we are today with the Roth IRA in 1997. The Roth IRA was allowing for individuals to still make after-tax contributions, and even people who were involved in an employer's plan being able to contribute to an account where they don't get a deduction, but then giving them the added benefit of having all of their earnings, all of the gains within that account, ultimately be tax-free. And so that's how the Roth IRA really came into being. A lot of it was just based on changes to tax law over time and changes in behavior for individual taxpayers. So the traditional IRA in 1974, because of what occurred with different people reacting to the changes in the laws, ends up giving rise to the Roth IRA in 1997. And just one other note on Roth accounts. Some of you who may be involved in Roth accounts or involved in an employer-sponsored plan know that in 2006, part of President George W. Bush's tax changes of 2001, in 2006 you can now, if you're involved in a 401k plan at your work or through your employer, your salary deferral, that your individual contributions to the plan can be made now as Roth contributions if you wish. So kind of just go over a little bit about the differences between traditional and Roth IRA accounts. Now, Again, as we kind of mentioned in the history of the IRA, a traditional IRA is anyone who has earned income is eligible to contribute to a traditional IRA account. So regardless of what income status you're in, what income brackets, tax brackets you're in, if you have earned income, defined as W-2, Schedule C income that's subject to self-employment or FICA taxes, you can contribute to a traditional IRA. Now, as we mentioned, the deductibility for making a contribution can be based on your income and also whether or not you were involved in an employer-sponsored plan. So if I have if I'm involved in my company 401k plan and I want to make a contribution to a traditional IRA, my ability to deduct that contribution can be limited based on what my income level is. Now, the benefits that the traditional IRA gives you is that you get, if you do make that contribution and you're eligible, you get that tax deduction. So it lowers your current tax bill. So if I have $100,000 of income, I make a $5,000 traditional IRA contribution, I only have to pay income tax on $95,000 in a given year. So it gives me a little bit of help in my current tax bill, and I get the benefit that the growth within that account, so if I invest that $5,000 I've contributed, I'm not going to pay taxes each step of the way as I grow the money within my traditional IRA account. It allows me to compound my investments and compound my earnings much more quickly. Also, any old 401k or 403b, 457 plan, other types of employer-sponsored plans can all be rolled into a traditional IRA with no tax consequence. Again, that was one of the things Congress addressed when they created IRA accounts, was the ability for individuals to move their money from an employer that they're no longer with into an account that they had greater degree of control over. Now, as far as the deductibility limits, again, if you are covered by an employer and you're covered under an employer's plan, even if you're not contributing to the plan, but you're covered under that plan, your ability to contribute to a traditional IRA is not affected, but it's the deduction that you may not get. So if you're a single individual and you're covered under a 401k plan at work, once you have over $72,000 of adjusted gross income, your contributions to a traditional IRA are not deductible. Okay, so you can still make the contribution, you're just not going to get a deduction. Now, if you're married filing jointly, and you're the one who has it's your 401k that you're involved in, and you want to make a contribution for yourself, at $119,000, you can no longer get a deduction for your contribution. And you can see the other numbers if you're someone who's married filing separately, or if you're the spouse of the person who has the active 401k plan. So one of the biggest differences as well between a traditional and a Roth IRA is how they're treated at distribution. But let's just cover kind of just what the regular IRA distribution rules are first. With any IRA account, there's a 10% penalty for any withdrawal that occurs from the account, any distribution out of the account, if you're under the age of 59 and a half. So the full amount, if you take a $10,000 distribution and you're age 55, you have a $1,000 penalty for pulling that money out early. The government wants you to leave that money in the plan. They want that money to be in there when you reach retirement age so that you have it to live off of, and again, reduce your reliance on government and government services. So they have this penalty in there to dissuade you from taking any money out of that account. Now, with a traditional IRA, once you reach age 59 and a half, whatever you pull out of the account as a distribution is simply included in your ordinary income. So if I take a $10,000 distribution out, I'm age 62, that $10,000 just gets lumped into all of my other income from the year, and I pay taxes accordingly on that money. Now with traditional IRAs, and any tax-deferred account, not counting Roth IRAs, you are required at age 70 and a half to take a minimum distribution. And it must be taken the beginning of the year you turn 70 and a half and each year thereafter. The government essentially at this point, if you have not taken any distributions out or have not taken enough, at age 70 and a half, they want you to at least take a portion out of the account to generate tax revenue. They don't want you continuing tax deferring all of your money. So at age 70 and a half is the point at which you are required to take at least a portion of the funds out and then pay taxes on it. Again, this only applies to tax-deferred accounts like traditional IRAs, regular 401ks, SEPs, and simple IRA accounts. So at age 59 and a half, you can take money out if you wish without penalty, but you're not required to take funds out of the traditional IRA until you reach age 70 and a half. Now, there are a few exceptions for that 10% penalty if you are wanting to take a withdrawal before you turn age 59 and a half. If you're pulling money out for the higher education expenses for yourself or a dependent, there is no 10% penalty. If you are disabled, if you inherit an IRA, you're the beneficiary of an IRA, there's no 10% penalty. Or if you're pulling money out as a first-time home buyer, you can pull money out prior to 59 and a half and not pay the penalty. With a traditional IRA, though, you still will have the tax consideration, so you will still be included in your income tax. All right, so the Roth IRA, just to contrast again with the traditional IRA, works a little bit differently, and almost really the inverse of what the traditional does. Now, anyone who has, to contribute to a Roth IRA, you still have to have earned income. Again, W-2, Schedule C income. But there is an income limitation that we'll discuss on the next slide, that if you make over a certain amount or your adjusted gross income is over a certain amount, you are not eligible to even contribute to a Roth. Now, in the traditional IRA, it was a matter of whether or not your contribution was deductible. With the Roth IRA, it's a matter of whether or not you can even make that contribution to begin with. Now, the benefits that the Roth has, and again, the large portion of probably why individuals have Roth IRAs and why you're listening today about converting to a Roth, is that you make the contribution to a Roth IRA, you do not get a deduction for the contribution. So you don't get that initial write-off. The huge benefit that the Roth has is that when you reach retirement age, when you reach over the age of 59 and a half and you've had a Roth for 5 years, all of your gains from that investment, all of your earnings within that Roth IRA are completely tax-free. And that's the huge benefit that the Roth IRA has, is the ability to pay taxes up front on your contributions and never pay taxes again on those funds. And because there is no tax revenue for the government to realize off distributions, there is no mandatory withdrawal like there is with a traditional IRA. So at 70 and a half, you do not have to take money out of a Roth IRA. You can leave that account to your heirs, and they take out money tax-free over the course of their lifetime. Now, the contribution phase-outs, again, now the ability to contribute to a Roth IRA is phased out, again, depending on your income, and this is regardless of whether or not you are involved in an employer-sponsored plan. But for a single individual, once you have greater than $133,000 of adjusted gross income, which is the bottom line on the first page of your 1040, you cannot contribute to a Roth IRA. So even if you wanted to, you had the funds that to make that contribution, you simply cannot make that contribution. And you can see the similar numbers for married filing jointly and married filing separately as well. All right, we did have a question come in. It says, what retirement plans exist for those making greater than the upper limits of Roth IRA and have no 401k or 403b plan either? It's a great question. I think a couple things would be something to talk to a CPA or possibly a third-party administrator about. If you're self-employed, you can certainly look at starting your own 401k plan. But if you're working for an employer who's just simply not offering that to you, your options would be somewhat limited. To be making contributions to your traditional IRA on an annual basis, and then in turn doing a conversion to the Roth, which we're going to talk about here in just a minute. The ability to still make a contributions to a Roth, to a traditional, and then move it into a Roth. But again, if you're looking for contributions greater than that $5,500 or $6,500 a year, the plans that exist are either defined benefit plans, they're 401ks, they are SEP IRAs or simple IRAs, but those plans really all require you to have an employer that is sponsoring that plan. So if you're self-employed, the good news is for yourself, it's just a matter of choosing which of these plans you want to offer to yourself and possibly any employees that you have. If you are working for an employer who's not offering a 401k and you have no other kind of side industry or side business to work on, unfortunately, your plans and the plans that are out there exist for you really are limited to just the traditional and the Roth IRA account. I hope that answers your question. Again, anyone else who has other questions, please type them into the chat box if you get a moment. So the Roth IRA, again, distribution rules are different, obviously, we've already talked about, than the traditional IRA. Now, the Roth IRA has kind of two main categories that you must meet in order to take out tax-free distributions. So one, you have to be over age 59 and a half. If you're under age 59 and a half, the IRS will hit you with that 10% early withdrawal penalty if you're under that age. Now, that withdrawal penalty does not apply to contributions. So the money you put in out of your pocket into a Roth IRA account can always be taken out without any tax consequence. But anything over and above your contributions is subject to a 10% early withdrawal penalty if you're under age 59 and a half. So that's very similar to the rule that we saw with the traditional IRA. The other requirement is the IRS says you must have a Roth IRA open for at least 5 years in order to take tax-free distributions of earnings as well. So it's over 59 and a half, and you have to have a Roth IRA for at least 5 years. Now, one question we get asked a lot, if I have a Roth IRA, I've had a Roth IRA at Schwab for the last 10 years, I want to use that money to invest in a self-directed asset, I want to buy a piece of real estate or make a private loan with that money or invest in a private placement, does that restart my 5-year clock? And the answer is no. The 5-year clock starts when you open up your very first Roth IRA account and make a contribution, and that carries it through all the way through all of your other Roth IRA accounts as well. Now, there's similar exceptions if you want to pull money out of a Roth IRA prior to 59 and a half. There are other exceptions to that early withdrawal penalty, same as the traditional IRA as well. Now, there are some ordering rules when it comes to taking money out of a Roth. When you ask for a distribution from your Roth IRA, there's certain rules of kind of how that money actually comes out. Now, the contributions you've made to the account over the years, the yearly, the annual contribution you've taken out of your pocket, put into an account, that money comes out first, kind of the FIFO rule of accounting, first in, first out. The contributions that you've made to the account are always distributed to you first. And again, kind of looking up in the slide, there is no 10% withdrawal penalty for taking out your contributions. You can always withdraw your contributions to a Roth IRA at any point that you wish. It's once you start touching earnings that you have to worry about the 59 and a half in that 5-year period. Now, any amount that you have converted from a traditional to a Roth IRA, what we're going to talk about here in a few minutes, that conversions are just deemed to be distributed second. So you can have the first layer that comes out as the contributions. The second layer is any of your conversions. Now just note that each conversion does have its own 5-year period that money must season within a Roth IRA. And then lastly, the earnings are what are distributed last out of a Roth IRA. So it's you kind of have to keep records and good records knowing exactly how much you've contributed over the years to really know what any kind of tax impact might happen if you're pulling money out of a Roth prior to 59 and a half and prior to that account being open at least 5 years. All right, so we had a couple more questions pop up. I'm going to get those addressed quickly. Once a 401k is rolled into the Advanta IRA, so if somebody has rolled money in from an old employer's plan into an Advanta IRA, can partial transfers to other IRA accounts be done without tax or penalties? The answer is yes. I mean, once you have money within IRAs themselves, so you roll over that money into a traditional IRA or into a Roth IRA, and you want to move a portion of that to a brokerage firm or some other firm holding assets, there is no tax, there is no penalty to move money as long as the money goes directly from one trustee to another. So if you've rolled over a 401k to us and you need to move a portion of that to a brokerage account, you're not going to be looking at any penalties or taxes for moving that money out, as long as you don't touch those funds. Next question, is there an annual limit for converting traditional IRA funds to Roth IRA? The answer is no, and that's kind of jumping the gun just a little bit here on the slides. We're going to talk about the rules for converting here as we move forward. So this slide, you just see a comparison kind of with the traditional and the Roth IRA. Again, the Roth IRA, this can be tax-free growth. The Roth IRA allows for contributions past age 70 and a half, and some more flexibility with distributions because you don't have to take any distributions at age 70 and a half. You can, again, leave that money to your heirs to take out in the course of their lifetime. Another question came up. I want to do a Roth conversion. Can I do that with the traditional Advanta self-directed IRA that you hold? Absolutely. We'll talk at the very end about some of the different things we will need at Advanta in order to do that conversion. But we can certainly convert. We've had many people over the years convert traditional holdings into their Roth account, basically here at Advanta. Another question, can I transfer from a previous employer traditional 401k to a Roth IRA by paying the taxes during conversion? Or can I convert the traditional 401k to only Roth 401k? The answer is you can roll over from a previous employer's 401k into a Roth IRA and then end up paying the taxes that are due on the conversion. Now, one thing we'll talk again a little bit more detail in just a moment. When you do a conversion, either from a traditional IRA or even a traditional 401k into a Roth account, the taxes are not withheld from the amount that you're converting. So if I have $100,000 I'm rolling over from a 401k into a Roth account, that full $100,000 goes into the Roth IRA. Okay, I don't withhold 10% or 20% or anything like that. It's just when I do the conversion, the full amount gets moved over, and when I reach retirement age, I'm going to take that back. When I go to file my taxes the next year, that $100,000 I converted will be included in my income. So it's something you have to remember, that the taxes are not going to be withheld. The full amount gets moved over. You will then have to account for the taxes when you file your 1040, and in theory be able to pay any tax bill personally. Now, this is a great question. Again, jumping the gun just a little bit, but good to get those out there. So please keep them coming. Now, one question that I've heard over the years from a number of people, and this is just kind of my personal take somewhat on this question, but people ask, the Roth IRA seems too good to be true because the income that you're generating is all going to be tax-free to you. Certainly the government doesn't like this because they want tax revenue. Again, we all know that that's generally what the congressmen and representatives and senators are always going after, is more tax revenue they can put into different projects or different programs. So why would Congress be okay with allowing Roth IRAs to continue and people to continue to have tax-free growth within their account? The answer is, I think, twofold. I think, one, some of them may have issues with it because they're realizing now what happens for future gains. But the other reason I think that I don't see the Roth IRA going away is the effect that contributions to Roth IRAs have on tax revenue today. So we're kind of look at this little example that I put on here. This is why, again, I don't see Roth IRAs going away. If you have 100 individuals who all make a $5,000 contribution to a traditional IRA account, that's going to result in $500,000 worth of tax deductions, right? Because everybody's going to claim that $5,000 contribution on their tax return, which in theory is going to give them then a deduction. And if we just figure the average taxpayer's rate is 20%, 20% of that $500,000 worth of deduction, this is ultimately results in the $100,000 less tax revenue that the government receives this year. Okay, because everybody's making that deduction, they're not paying as much in taxes. That's $100,000 less just based on those 100 individuals making contributions. Now multiply that by the actual number of people that contribute traditional IRA. Now the government realizes they will get tax revenue down the line on distributions, but for this year, for those 100 people, it's $100,000 less in tax revenue that they get now. Now, if those same individuals simply made those contributions to Roth IRAs, there would be no deduction, so the government gets $100,000 more in tax revenue now and realizing they're not going to get anything in the future. Again, for that reason, that's why I really don't see the Roth IRAs being eliminated, at least at this time. The tax revenue, I think it's more important for congressmen in office now to get that revenue now. And I think they understand that this concept of encouraging Roth IRAs means no deductions. Now, again, this certainly could change in the future. Other circumstances arise. But for right now, that's why I don't see Roth contributions going away as well. In addition, the amount of uproar there would be if they tried to take those away. We saw what happened when President Trump floated an idea about limiting 401k or IRA contributions this year. The uproar that followed quickly, that was axed from their tax bill. So we'll talk about now getting into really more the nitty-gritty and the details about doing conversions. Taking money from a traditional IRA or an old 401k or a SEP or a simple, moving that money into the Roth IRA so that everything is now going to grow tax-free. So really, in simple terms, a conversion is basically what I just described, taking money from a pre-tax account, like most often we see it's a traditional IRA, but as we talked about already, it could be an old 401k too. Moving that money into the post-tax account, the Roth account, paying the taxes now, agreeing, saying this next tax cycle, next tax deadline, I will pay the taxes now on that conversion, and realize that all the money now is going to be growing completely tax-free. So you're paying, basically electing, I'll pay taxes now and subject myself to the tax bill now, rather than doing that down the line. So the conversion rules, and we had a question about this earlier, there is no income limit for converting to a Roth IRA. So Bill Gates, Warren Buffett, all those individuals that are always in the news could convert to a Roth IRA if they wish. They're just going to have to pay income tax on the amount that gets converted to the Roth. So there is no limit. This is a rule that was changed back in 2010. Now, again, the fair market value of any conversion is reported to the IRS on a 1099-R, and again, it's for the calendar year in which the conversion is done. So basically your conversions have to be done prior to December 31st because it has to be done in the particular calendar year for that conversion to count for that year. You cannot go back and convert for prior years once that December 31st is passed. I think there's a lot of individuals who will go sit down with their tax advisor in January, in February, maybe even in March, to talk about the prior tax year and say, hey, there was a great opportunity for me to do a conversion, and by this point it's too late. It has to be done prior to December 31st. So with this rule, because there is no income limitation on converting to a Roth, with this rule in place, you can take money into even if your adjusted gross income is too high to contribute to a Roth, you could always first contribute to a traditional IRA because there's no income limitation there, and then immediately do a conversion of those funds to a Roth IRA. Some people will call that like a backdoor Roth IRA. Heard a few other different terms describing it too, but it's essentially if your adjusted gross income is too high to directly contribute to a Roth, you basically put the money into a traditional IRA and then immediately convert that money to a Roth because there is no income limitation on doing that conversion. Now, we did have a couple of questions pop up I want to make sure that I address. First one's the strategy to take 401k to IRA rollover, then slowly withdraw and roll each year to Roth and pay smaller tax each year on the rollover. That certainly is the strategy that people have done. When we're talking about conversion, it is not an all or nothing proposition. You can convert as much or as little each year that you wish. So some people will look at their tax situation on a year-to-year basis and basically convert what they can stomach from a tax standpoint. We've had people split taxes up over 2 years by simply converting some on December 31st and the rest on January 1st, for instance. Now we have another question said, how did former President Romney have several $100 million in his Roth IRA account? You can probably Google articles on that. It's a little bit outside of what we're going to talk about today. In short, his Roth IRA, from what I can gather, his Roth IRA bought private stock in developing companies at a very major, at a severe discount based on how those companies were performing at the time. When those companies turned it around and got profitable again, the preferred stock that he purchased in his Roth IRA was worth significantly more. So that's how he was able to gain or have such a large balance inside of his Roth IRA account. Another question, I plan to convert big bucks of traditional IRA to Roth IRA for tax year 17 after 31 of December. Did I get this wrong? The answer, in short, is yes. You still have time, but any conversions that you want to do to count for tax year 17 must be done by December 31st. If you wait till January 2nd or January 3rd to do a conversion, that's going to count for tax year 2018. So you do need to make sure you get that accomplished here prior to December 31st. Can I convert one property from an existing self-directed IRA? Yes. Again, as I just mentioned, you can convert all or a portion, whatever you want, from a traditional IRA to a Roth. There is no requirement that you transfer or move the entire thing. Can an individual open and contribute to a traditional IRA directly without any employer involvement? How does the tax deduction work in this case? If you do not have an employer involvement, you don't have a company or you're not covered under a 401k, and you make a contribution to a traditional IRA, you will get a tax deduction for making that contribution. So you'll get a tax write-off for $5,000. If you then in turn convert that money into a Roth IRA, you will realize $5,000 of income. So in that specific circumstance, the deduction for the traditional IRA would wipe itself out with the then conversion to the Roth IRA. It will have been as if you made a direct contribution to the Roth IRA account. Can you convert a traditional IRA that was inherited from a deceased spouse to a Roth if you're over 80? The answer is yes, because if you inherit an IRA from your spouse, it's typically treated as your own account, and as your own account, you can do a conversion if you're over 80. It's just you want to make sure that it makes sense to do a conversion at that age, and we'll get into some of the factors here in just a minute. But you certainly can convert at any age, regardless of what age you are. But again, that's going to really, the age factor really determines whether or not it makes sense to do a conversion at that time. So just some things to remember on conversions. Again, they must be done by December 31st, not April 15th, which is a lot of people associate your contribution deadlines for traditional and Roth IRAs is April 15th. And so individuals will think, oh, that's the deadline at which I have to do the conversion. Conversion must be done by December 31st. The amount that you convert is included in your taxable income and can bump you up to higher tax brackets. Again, one of the questions that we get from time to time is, what is the tax rate on doing a conversion? Well, there is no set tax rate because it's going to depend on what bracket that you fall in, as well as the amount of the conversion. Once it's lumped in, it can bump you up into higher tax brackets. That's why, again, when you're looking at doing a conversion, you need to talk to your tax advisor, make sure they're on board with what you're doing and they're giving you the guidance. They can help run the numbers as well based on estimates of what it's going to look like, what it's going to cost you in order to do the conversion. Now, if you do have losses, say you own your own business and you have business losses or other investment losses, those losses on the return can offset the income from a conversion. I mean, again, this is just income when you do a conversion, just goes on your 1040, just gets put in ordinary income. Any other losses you have may be able to limit the impact you would actually have from doing that conversion. And also, the other thing to remember, again, important, especially the question we've had when we talk about doing Roth conversions before December 31st and not yet being 100% sure on how this is going to impact you for the tax year until you sit down with your accountant and review the prior tax year. You can undo conversions by doing what the IRS calls a recharacterization, which you basically take the amount of your initial conversion plus any earnings that are attributable to that conversion, basically must be recharacterized and just pulled back into a traditional IRA account. The deadline to recharacterize is your tax return date, April 15th, plus extension, so potentially all the way up until October 15th of the following year. So we certainly have seen individuals convert in November, December, then February or March comes along and they realize, hey, this wasn't the best idea based on the tax implications that I'm going to have, so I need to do a recharacterization. That certainly is possible to do. Again, some more questions. Can my wife and I share the same IRA account with Checkbook LLC so we can roll our IRA into a combined self-directed IRA? The answer, outside of today's webinar, but the answer to that question is an IRA can only be owned by an individual. So you cannot have a combined IRA. So husband and wife would each have to maintain their own separate IRAs. But you could have both of your IRAs partner up into the same Checkbook LLC that you're talking about. That's a great question. We probably could take offline to go into more details. But you cannot have a combined IRA. You can't have a joint IRA. Husband and wife would each have to have their own separate ones, but you can use them in conjunction when making investments. Question, would it make sense to convert over 80 when thinking of leaving the money tax-free for the beneficiaries of your trust? And that will get us right into the questions on kind of why or when to convert, or maybe no, why not to convert to a Roth IRA. Now, here's a list of some of the reasons, thumbs up, reasons why you would want to convert to a Roth IRA. If you're expecting larger returns on your money in future years, so you're making an initial investment, you expect you to have a lot of growth it can make sense to do the conversion now before those gains are realized and pay tax on that smaller amount. Also, for someone who has a longer time before retirement, that simply gives you more time to build that account and have that account growing for you tax-free. If you're expecting a higher tax bracket or rates in the future, so you're kind of the bracket that you're in this year, or this year's a low tax situation for you, it can make sense to convert now. If you're expecting that in the future you're going to be in a higher tax bracket, you're going to have a higher tax rate when you're pulling money out of a traditional IRA and having to pay tax on it. So instead, getting that money in the Roth now and then not having to worry about what happens. If your traditional IRA contribution is not tax deductible, so you go ahead and you make that non-deductible contribution, it can make sense to convert that then obviously to a Roth IRA. Or if the assets in your account, this may not be true at the moment, but a lot of IRAs are currently doing well with the different markets that they're invested in. But if your asset in your IRA has a depressed or low value, again, the value that is placed on what is converted is at the time of the conversion. So if you're sitting with an asset, again, that is currently much lower than it historically is, when you do the conversion, what you pay taxes on will be on the current value, not on any historical or future value. Again, if you have losses to offset the income, and estate planning reasons, which was the question we just indicated. If you wanted to leave money tax-free to your beneficiaries, obviously converting to a Roth IRA would accomplish that. It's just, again, you have to look at the impact on yourself of making this conversion at this age and what income bracket that's going to place you in. May not be the best thing to do, but again, that's something to talk with about a tax advisor. And as I mentioned earlier, the ability to pay the taxes due on the conversion, the tax is not withheld from the conversion itself. So again, you moved $100,000 from a traditional to a Roth, that full $100,000 gets moved over. You get a 1099 for $100,000, and then from there, you'll have to pay your income tax when you lump it in with the other income that you've had for that particular tax year. Now, the reasons why not to convert are a lot of them are the inverse of what we just talked about. If you are someone who's closer to retirement, you're not expecting any significant growth, it doesn't necessarily make sense to pay a large tax bill now when you can simply take money out piece by piece from your traditional IRA and have a lower tax impact. And if you're going to be in a lower tax bracket in retirement, if you're currently in a high bracket, it doesn't make sense to pay 35% in taxes if you anticipate when you're in retirement that you might only be in a 15% bracket. If your values are inflated or you're expecting values to decrease, you again don't want to convert when the value is high because you're going to end up paying taxes on that higher value. And if you don't have the available cash to pay the taxes due on the conversion, again, that's another major consideration, again, with the taxes not being withheld. The fact that you need to have outside sources. If you end up converting $100,000 to a Roth IRA account and then taking money out of the Roth to actually pay the taxes, you're going to have that 10% penalty that you're hit with in pulling that money out of the Roth to actually pay the taxes. It's a good idea to kind of look at that at the outset. Now, one other huge red flag to consider if you're, or maybe why not to convert to a Roth, the income that you get from doing a conversion, again, it's going to be just included in your ordinary income, can result in a loss of certain government benefits, either the child tax credit, Medicare premiums, of other Social Security benefits, other things that are government programs that are based on your current income level can be affected based on you simply doing a conversion. And this was something that happened a lot back in 2010, 2011, when a lot of individuals were taking advantage of a 2-year conversion process that the IRS and government laid out on a one-time deal. People were doing conversions because it simply made money sense, and not realizing that when they put that income on their tax return, this resulted them in losing certain Medicare premiums and other tax credits as well. So please, if you have certain government programs or other benefits that you get, keep that in mind. And again, that's why if you're 80 years old, if you are receiving any of those benefits, that's something to obviously consider as well. Now, one question we had stemmed about how can I convert my Roth IRA or convert to a Roth IRA with Advanta prior to December 31st. Now, if you're looking at converting a self-directed traditional IRA to a Roth, you're basically going to need two main things. Now, there's a couple forms you'll fill out for us to actually open up the Roth IRA and tell us you're doing a conversion. But the two main pieces of information that you're going to need are you'll need to obtain a qualified fair market value from an independent third party, and we will also need documentation to actually transfer ownership of the assets. Now, if you're converting cash, if you're converting a mutual fund or a stock with a brokerage firm, typically these items are not needed because they can obtain the fair market value of your brokerage account the day you do the conversion based on what the stocks or bonds are trading at, and they'll simply just roll that asset into a Roth IRA instead. But when we're talking about self-directed assets, we're talking about people buying real estate, talking about people investing in promissory notes, LLCs, et cetera. There is not a readily available value to tag to that particular conversion. The IRS requires us as Advanta, as the administrator, to report to them what the current fair market value is of an account that's being converted. So in order for that to occur, we need you as the account holder to provide us with a qualified fair market value from somebody who's independent, from a third party. And then we're also going to need documentation, whether that's a deed, an assignment of a mortgage, re-registering an LLC or an LLP or brokerage accounts. We can help guide you a little bit based on what type of asset that you have, but it's up to you ultimately to help obtain that documentation. Now, qualified fair market valuation, again, the IRS defines the fair market value and getting that valuation as being provided by someone who is independent and qualified to value the particular asset being converted. In general, CPAs, attorneys, appraisers are people that could provide that valuation for you. If you're converting, say, a piece of real estate using the tax assessor's value, it's not sufficient for us in doing a taxable event conversion within your account. So you would need to get an appraiser, for instance, on any particular piece of real estate. All valuations should be done within a reasonable time period. Usually we want to see a valuation done within the last 30 days prior to the time of the conversion. Values will fluctuate. Again, not the piece of real estate, it's not fluctuating on a minute or daily basis like a stock account would be, but it is going to fluctuate somewhat in that 30-day time period. So we need to have a valuation done within 30 days, and again, it has to be done by a third party, which is one of the questions that just popped up. If my property was purchased this year in my IRA, do I really need a third party? If it was purchased within the last week or so, a week or two, no, probably not. We can just go based on that value. But if it was purchased at any time prior to that, we are going to need a new independent valuation, again, probably from a real estate appraiser, to accurately assess what the current value of that asset is. So the documentation, again, with real estate, it's typically an appraisal, not a broker's opinion, not the tax collector's number, but an actual appraisal. If you're converting, say, a promissory note or a mortgage, In general, the fair market value would be the amount of the outstanding principal plus any unpaid interest. You can get a CPA or an attorney or someone to sign off on that value based on an amortization schedule. That would be sufficient. If you're holding a private stock, private LLC, private partnership, if the manager, president, or an officer is not really qualified or truly independent, then you need to get an independent third party. Get a CPA to examine either the books of the corporation, or if the manager provides a valuation to you and your CPA signs off on it, they agree with the valuation, that would be acceptable. If it's a privately traded stock and there is a stock value on a current offering, that typically is sufficient as well. Any other assets, just contact us directly for guidance as well. Question said, can a Roth be self-directed and invest in a real estate by the owner of the Roth? And the answer is yes, and that's what we do here at Advanta. Again, today's webinar didn't go into that much detail about buying property with your IRA account, but that's what we specialize in doing, is any type of IRA, traditional or Roth, buying rental properties, buying promissory notes, buying private LLCs, and then holding that as the asset within the particular Roth IRA account. And the Roth owner, as in your question indicates, would be the one directing all of the activity as well with that particular asset. So basically to finish up this webinar, if anyone has any other questions, please get them in. So the bottom line again, so should I convert? I think it goes without saying, but I'll say it anyway. Everyone's situation is unique, and your situation may be unique year to year based on your income, your tax brackets, your tax statuses on a year-to-year basis. Conversion can make sense one year and not make sense the next year. There are conversion calculators that are on the internet that you can kind of enter in how much you're looking at converting to figure out whether or not it makes sense. It typically, your age and your expected future returns really are the most important factors that determine whether or not this conversion makes sense for you. Those conversion calculators can help, but it does involve obviously you projecting what some returns might be. And again, I think getting a trusted tax advisor to assist you is key. Getting someone who knows what your situation is, knows how you file, your filing status, and being able to kind of let you know dollar for dollar what that's going to look like. You can always convert and then undo it in the next tax year. Again, as long as you get it done by December 31st, sit down with your accountant in February and say, you know what, this doesn't make sense now that I look at it. Let's recharacterize it and undo it. You can certainly do that as well. So don't miss the deadline of December 31st to have that done. And as again, one other question individuals had looked at and had suggested, you can convert in different years. You don't have to do it all at one time, but I have seen clients convert half of their account on December 31st and do the other half on January 1st and end up splitting the tax bill that's due over those particular tax years, because one of them, part of the conversion took place in one tax year and the rest took place in the next year. So again, those are some things to consider when you're thinking about converting. We've had some great questions, and if you're listening to the live version, if you missed anything, the recording will be up on our YouTube page probably another day or two. You should get an email with the recording as well. If you're listening to the recording, and if you have any questions, my contact information was on one of the first slides. You can reach me at 727-581-9853, extension 1123, or my email address is smaurer@advantaira.com. So at this time, I thank everybody for attending the webinar. I had a lot of great questions. If you have any questions, again, about converting your self-directed IRA, make sure you get in touch with us so we can let you know what that process looks like and make sure we get it done here by the end of the year. So this time, I'll finish the recording. And again, thank you, everybody, for listening.